If you have federal student loans or someone in your house does, this is one of those moments where you probably do not want to ignore your email because student loan repayment has changed again. And I know that sounds exhausting because student loans have been through years of pauses, restarts, forgiveness, headlines, confusing notices from loan servicers. So let's make this plain English. The biggest change right now is that the SAVE plan is ending. SAVE stood for Saving on a Valuable Education. It was an income-driven repayment plan that many borrowers used because it often created lower monthly payments and in some cases, very low or even $0 payments. The Department of Education says more than 7.5 million borrowers were enrolled in SAVE, so this is not a tiny group of people. This could affect millions of household budgets. And in plain English, this means a lot of borrowers are going to have to pick a new plan. And for many of them, the new payment may be higher than what they were used to under SAVE. That is the real world update. It is not just that a program ended or that a court case happened. The practical issue for most borrowers is figuring out what their new monthly payment is going to be. Starting July 1st, loan servicers began sending notices to borrowers who were in SAVE. Those borrowers are being told they need to choose a new repayment plan within at least 90 days. If they do not pick a new plan, they can be automatically moved into either the standard repayment plan or the new tiered standard plan. And that matters because the standard style repayment plans are not always based on your income the way income-driven plans are. So depending on your income, your loan balance, and your family situation, the automatic move could be a big payment shock. The new repayment system is supposed to be simpler, but simple does not always mean painless. There are two newer options people are going to hear about. The first is called the Repayment Assistance Plan, or RAP. RAP is income-based. Your payment is generally based on your income and the number of dependents you have. The Department of Education says monthly payments under RAP are between 1% and 10% of your income, and borrowers get a $50 per month reduction for each dependent. RAP also includes some protections around unpaid interest if you are making full on-time payments, which matters because one of the most frustrating parts of student loans is making payments and feeling like the balance never goes down. The second newer option is the Tiered Standard Repayment Plan. That plan is not income-based in the same way. Instead, it uses fixed repayment terms of 10, 15, 20, or 25 years, depending upon how much you owe. So instead of thinking which plan sounds best, borrowers really need to ask which plan fits my actual life, because two people with the same loan balance may need very different repayment strategies. One person may have a high income and no dependents. Another may have a tighter budget and be working towards loan forgiveness. That is why this is not a set it and forget it moment, because assuming your old payment will simply continue unchanged could lead to problems. In many cases, it may not. If you are in SAVE, you need to watch for communication from your loan servicer. You need to log into StudentAid.gov. You need to confirm which plan you are currently in, and you need to compare what your payment would look like under the available options before the deadline. And please, do not wait until the last week. We are talking about millions of borrowers being moved around the same time, which means servicers are likely to be busy, websites may run slowly, and call centers could be very frustrating to deal with. So if something is wrong on your account, you want to give yourself enough time to fix it. One more thing. If you are pursuing public service loan forgiveness, be extra careful. PSLF was not eliminated, but your repayment plan still matters. Public service loan forgiveness generally requires qualifying employment and qualifying payments. So before you switch plans, you want to make sure the plan you choose keeps you on track. This is where I would be very cautious about taking advice from a random comment section. Student loans are complicated, and the wrong move can affect your monthly payment, your interest, and your forgiveness timeline. So here is the practical checklist. First, find out whether you were enrolled in SAVE. Second, check your servicer notice and your actual deadline. Third, log into StudentAid.gov and compare your repayment options. Fourth, estimate the monthly payment, not just the long-term forgiveness number. And fifth, if you are pursuing PSLF, confirm that your new repayment plan counts. Finally, sixth, keep records. Save notices, confirmations, screenshots, anything showing the plan you selected. Because when the student loan rules change this much, documentation matters. The headline is that SAVE is ending, but what it really means for your household is that millions of borrowers may need to choose a new plan, and many could see their monthly payment change. For some, the new payment may be manageable, while for others, it may be higher than expected, and for a lot of people, the most stressful part is simply not knowing where they stand. So if you have federal student loans, this is your reminder, do not ignore this. Check your plan, check your deadline, check your payment, because student loan policy may feel like a Washington story, but the impact shows up in real life and in real budgets every single month. That's it for this week. This is Jeannie, the 401k lady.